I'm Matt Bishar with NAREIT's REIT.com here in Washington, D.C. for NAREIT's Washington Leadership Forum. Joining me for this CEO Spotlight is Mitchell Sabshon, the CEO of Inland Real Estate Investment Corporation, which is the sponsor of two REITs, of which Mitchell is the CEO, Inland Real Estate Income Trust and Inland Real Estate Residential Trust. Mitchell, thanks so much for joining us today.
Thank you for having me, Matt. It's a pleasure being here.
Now, last year was an active one for the company on the acquisition front. Can you talk about how the deals, particularly we're speaking of the Inland Real Estate Income Trust, how those deals have reshaped the company and what types you're targeting for 2015?
Well, as you know, Inland has two primary businesses. We are the sponsor of non-listed real estate income trusts, and we also are a sponsor of private placed real estate transaction syndications. Those two businesses in 2014 combined to make acquisitions of just a hair less than $1.3 billion. About 30–35% of that was in our REIT, Inland Real Estate Income Trust, and the balance of that was in our private placement business. It was an exciting year. We focused primarily on multi-tenant retail, mostly shopping center anchored retail, as well as apartment buildings. We've seen some movement in pricing on apartments, on multi-tenant, multifamily residential properties, and we think that opportunity is very exciting. We're taking advantage of it.
And within your portfolio, what are you seeing in the way of fundamentals, and are there any areas of particular strength or weakness that you're looking to capitalize on?
Well, given where we are in the economic cycle, I think most people would agree that we are at a 6-year high in the U.S. economy. Needless to say, we have geopolitical forces that are working hard against the growth in our economy, but we are seeing increase in GDP, lowest level of unemployment in 6 years, job creation, just across the board, strong economic fundamentals. And as a result, that's driving our strategy of acquiring real estate that has both a significant amount of anchor to it, which drives traffic, but even more so, a substantial amount of small shop inline space where we have shorter leases and the opportunity to raise rents, to capture growth and participate in the growth of the economy. We think for the next 5–6 years, barring any significant extraneous geopolitical factors, we think that we can take maximum advantage of growth through those types of properties.
And lastly, there's been a lot of discussion about changes, reporting changes for the public non-listed REIT sector. What impact do you think these regulatory changes might have on Inland or the sector as a whole?
Well, I'm very excited about the recent amendments to specifically FINRA Rule 2340. I've gone on record as advocating the very changes that were implemented in the rulemaking this year. A criticism of the non-listed REIT space for many years has been a lack of transparency, a lack of regular periodic valuation of non-listed REIT shares. Of course, listed REITs are valued every day in the open market. And the purpose of the rulemaking change was to make the pricing of those shares far more transparent. In fact, to show the real estate commissions, selling commissions, dealer manager fees, organizational and offering costs up front. My belief is by making that impact on capital transparent, those fees will come down over time. And I can tell you it's a win-win for the investor and for Inland as a sponsor. When you have a $10 offering and maybe $1 or $1.10 or $1.20 is expended to create the capital, to gather the capital, that means that we're starting back $1, $1.10 behind that $10 price just to get back to par and then add value to investors.
Great. Mitchell, thank you so much for joining us.
Again, it's my pleasure to be here, Matt. Thank you so very much for having me.
For more on this and other REIT news and analysis, be sure to visit REIT.com.